Hello, I'm Russ Mould, AJ Bell's Investment Director, and in this latest edition of our regular markets review, Breaking the Mould, I'm going to be looking at cruises, DIY and water. All three of these topics look capable of causing a fuss in the week ahead because all on the same day, Tuesday the 20th of September, we have a trading statement from cruise ship giant Carnival, interim results from DIY expert Kingfisher, and finally a trading statement from FTSE 250 water utility Pennon. So let's start off with a gentle cruise and FTSE 100 travel giant Carnival, which is, by the way, also quoted on the New York Stock Exchange. The company is due to publish a third quarter update on the 20th. Now, Carnival shares have found they're going pretty choppy of late, not least because of recent profit warnings from major international peers and rivals, Royal Caribbean and Norwegian cruise lines. Now here's Carnival's share price, and then in the next graphic we can see that of Norwegian and Royal Caribbean, who frankly actually done a lot worse. Norwegian had already flagged weaker demand for cruises around the Med and the Middle East because of terrorist attacks, and it then cut 2016 and 17 forecasts, blaming poor demand for sailings to Europe from the US. Let's see what Carnival says about that, and also the Zika virus, which has now reached Asia, having started off in Brazil, and that's prompted one or two analysts to fret about another potential hit to customer demand, just as the cruise ship industry's gone on a capacity-adding binge. But back at the first half stage in June, remember, Carnival was very upbeat. Management increased earnings per share guidance for the full year to between $325 and $335 a share, a 20% year-on-year increase, and that despite unhelpful oil prices and currency movements. So let's see what the P&O operator says this time around. Pay particular attention to net revenue yields in constant currency, up 3.6% at the interims, and costs per available lower berth excluding fuel, which fell 1.9%, as well as any revision to profit guidance for the year. Now let's bang a few nails into some DIY and take a look at interim results from B&Q and Screwfix owner Kingfisher. The stock market initially gave a very cool response to boss Veronique Laurie's One Kingfisher programme when she unveiled the 5-year transformation plan for the company back in January, but the shares have since warmed up. As we can see here, they've rallied very nicely over the summer, encouraged by Laurie's determination to generate a £500 million profit uplift over the next 5 years and an additional £600 million of capital returns above and beyond regular dividend payments over the next 3 years. Now that's equivalent to around 26 pence a share on a share price that's around 370p as I sit here. Now, August's trading statement has already given us a hint of what Kingfisher's interims could look like. Sales rose 3% on a like-for-like basis, slower than the 3.6% seen in Q1, but the shares rose anyway, buoyed by good trading in Poland and the UK, where Screwfix showed over 13% like-for-like sales growth. Russia and Spain also improved, and the only real black spot was France, where the Castorama and Brico Dépôt chains suffered a 3.2% like-for-like sales decline. The question now is how these revenues translate into profits, and that's what the interims will tell us. For the full year to January, analysts are looking for 5% growth in earnings per share and a similar increase in the dividend, so perhaps that provides a benchmark for these first half numbers. Last, but by no means least amongst our trio of reporting companies from the 20th is utility and waste manager Pennon, which is set to release a first half update ahead of the actual numbers that are due in November. Now, Pennon runs South West Water, Bournemouth Water, as well as waste manager Viridor, and the investment case for the stock has generally rested upon its target of growing its annual dividend at a rate 4% higher than retail price index inflation. That goal's helped the shares perform pretty solidly over the past year, as we can see here. In fact, Pennon has a pretty solid history of growing its interim and final dividends, as this next graphic shows, something which may intrigue income hunters, who will therefore be keen to hear from Pennon about its balance sheet and capital expenditure plans in particular to make sure the dividend growth target can be met. Analysts currently expect roughly flat profits from Pennon for this year and a 7% increase in the total dividend to a fraction over 36p a share. That's enough for a yield of 4.1% on the 879p share price. And that's also a premium to the 3.5% yield on offer from the FTSE All Share overall. So thank you for watching, and I look forward to seeing you next time.